Is it okay if I take over from here?
Okay, well, let me introduce you, Nancy, and Gaurav, who is going to be giving us today's presentation. Now, they are founders of qplum, who is also listed on the Interactive Broker website under the Investor Marketplace. And I'll be showing you how to find their information on IB's website before we do end today's session. So with that, Nancy, I'm going to actually pass the controls over to you. Let me make sure that I've got you, and we're going to make you the presenter. So if you would, please share your screen, put it into full screen mode, and we'll get underway here today. Thank you, Nancy, and welcome.
Thanks for that, Cynthia. I hope everybody can see my screen now. So welcome to the Interactive Brokers webinar here. As Cynthia mentioned, I'll just start with some introductory information. So any information presented here is for educational purposes only, and we do not intend to make any offer or solicitation for sale or purchase of any specific products, investments, or strategies. My name is Mansi, and I have Gaurav here with me as well.
Hi.
Both Gaurav and I are computer science engineers by education, and I'm the CEO of qplum, and Gaurav here is the Chief Investment Officer. Gaurav had great success with applying data science methods in high-frequency trading, and my background is more traditional portfolio management, where in my last job at Bevan Howard, I was managing a global discretionary macro portfolio. Both of us started qplum in 2015, and we are exploring similar data science methods towards making investing a service for more people. qplum is an online investment advisory firm. We offer AI and machine learning based portfolios. We believe that investing is a science and not a game. And we offer dynamic portfolio plans along with risk management and along with a dedicated team that is with you to the important events of your life. So with that, I would love to start the topic at hand, which is how do you compare against a typical US household? How do we all compare against a typical US household? We have lots of questions for you as well. So we all will have multiple opportunities to engage. As the presentation is going on, you are welcome to type your questions, and we'll address some of the questions midway during the presentation and some at the very end. So with that, Gaurav, I'll hand it over to you.
Yeah, hi, I'm Gaurav, and it's a pleasure to be here. I have, let's say, just under 45-50 minutes to tell you everything I know, so I'll try to make the most of it. Now, I've had a lot of success in the past in sort of deriving alpha in trading, in machine learning, broadly what I would call machine learning based trading, but that is trading. Today we are talking about investing, and the reason we started qplum, and the reason I quit my very lucrative sort of job to start qplum is to make a difference. Is to change the world and to bring like the scientific method in investing. What we will talk about today that you have not heard before is the first step of a scientific approach to investing. The first step is to figure out what is the average case. The first step is to figure out what is a proper benchmark. Okay, let's get there slowly. So the things we will cover today are the importance of a benchmark. What are we making? What mistakes are we making in the benchmarks that we use today, and how can we fix that? What would be a right benchmark? Then we'll talk about the U.S. Investor Index, as we call it, and the data that we used in construction of the index. Then we'll look at all the component data, like how U.S. investors are currently allocated, what's the risk we are taking, how have we sort of panicked in the past. All aspects of the creation of the US Investor Index. Then we'll look at some interesting parts like how US investors compare to hedge funds. We'll look at a possible trading strategy that we can derive based on the predictable part of investor behavior. What we will not cover today, and I remember at Wharton, Dr. Steele, when and Mansi and I are a lot of our work are inspired by Dr. Steele's teachings. When he used to come in the class, first he would make like a draw line, and left of it he would write, what am I going to cover today and what I'm not going to cover today. So that's what we are not going to cover today are, whether I should be invested more in stocks or bonds, or humans versus AI debate, or specific trading strategies, and certainly not Bitcoin. So, one second. Okay.
So before we start this slide, we just have a very quick poll here that we would like to launch. You should be able to see the question, and we'll keep it open for 30 seconds. And this is just, just to get the conversation started about what percentage of your total assets would you say are invested, or would you invest in the stock market today?
Total assets.
And I'll be sharing the results of the poll in like 5 seconds. Okay, so it seems like we have a very aggressive crowd here. People are saying greater than 50% of their assets they're comfortable investing in the stock market.
Okay, so let's get in the details a little bit. So in real life, a kid in grade 3 is given an exam, and then they're told, how do you compare to other students in grade 3? They're not asked, how do you compare to everybody in the world? In real life, when you run, you compare against what the times you did and not against the champions of the world. In practice, especially in finance, we compare ourselves to the wrong benchmarks. We compare ourselves to something like the S&P 500 index, or maybe the stock that went up 10 times the last 10 years. The importance of a benchmark is it helps us see what is the average case. What are others like me doing? What are they doing with all their money? What am I doing differently than others? As in, what is hurting my performance compared to others? The average case of what others are doing with all their money. That's how I would define a benchmark for investing. When benchmarking our performance, we need to do the work then of figuring out what others are doing with all their money. And I want to, in this webinar, we will go into finding that information and making an index out of it. And I'm sure if you think, you'll not find a single index currently that really covers what all investors are doing with all their money.
So just before we cover this slide, I'm just launching the second question that we have for you guys. As I promised, this is going to be an interactive session. So what do you think is a good benchmark to compare the overall allocation of a US investor? And I'll be closing this in just about 5 more seconds and share the results with you guys. Okay. And nobody wants to be compared to US bonds. I agree with that. We do have some people who think US stocks are a fair benchmark, and majority think that it should be a diversified portfolio with a similar risk profile. which I personally agree with much more.
So yeah, I mean, if you look at FINRA's advice on benchmarking, they basically echo in very simple terms that don't compare yourself to what others are doing with a sliver of their money. So many of us, what we would do is let's say we have $1 million of net worth. Very nice. Out of that, 500K we'll keep in the bank, and as like sort of a fear of not risking that, so we set that aside, or bank or some instrument that basically doesn't have much downside risk, and the rest of it, some of it we play with as an invest in the riskiest assets, and the other part maybe we'll benchmark to real estate or stocks. It does make sense to look at our stock investment to compare that against US stocks, etc. But what I think is the first step of the scientific method is to look at what we are doing with all our money, our net worth, and figuring out what others are doing with their net worth. Now, the wrong benchmark would be something like S&P 500. Now, if you talk to high net worth individuals, their investments are actually much more in real estate and private equity. So in that circle, if you ask somebody, hey, what's a good benchmark, they would probably be more inclined to things like real estate, etc. But you know, doesn't matter what. My point is that a diversified benchmark which accurately sort of reflects the amount of money invested in each asset class by US investors is a fair representation of the average case. So I need to find out the amount of money invested by, you know, the net population, the US households in each asset class. Then I need to find out a good benchmark for the way they are investing it for each of these asset classes, and then I need to sum them up, multiply by the amount of money invested to get a benchmark. So it would be a dollar weighted sum of how each of those asset classes are invested. Okay? So now we need to look for the data, and surprisingly, this data has been made available by the Federal Reserve, not recently, it's quite a while ago. Since 1950s, the US Federal Reserve provides data quarterly, not every day, but on a quarterly basis for what US households are investing in. So data is something like this. Like there's tons of details. There's just one snapshot, but it's something like a 180-page PDF with many line items. It talks about where we are investing in every quarter. So this table B.101 is the balance sheet of households and nonprofit organizations, which looks at the current value in billions of each asset class here.
And Gaurav, is this data available just via a spreadsheet or PDF, or now are there APIs for it as well? Yeah, so out of the many data series, about 20–30% are available via API, and for others you need to do more, you know, data cleaning. But yes, through FRED, St. Louis FRED database and APIs, you can get that. As soon as the Fed releases it, it's available via FRED. So point is, if you ask me, what are US investors investing in? Give me a dollar value for each of those asset classes. It's right here. So when I compare myself, my net returns, the returns on all of my my net worth, on returns on all of my investments, I should compare myself to a benchmark based on these numbers.
And that's exactly what we did. Now, this is just the current balance sheet. There's another data point we need to make to compute the investment returns. You see, let's take real estate for instance. In Q4 of 2016, the value was 26.166 trillion. In Q1 of 2017, the value is 26.551 trillion. That change could either be because people bought more real estate or appreciation, right? It could either have grown from 26.166 to somewhere in the region of 26.551, or people might have just bought more real estate. I need to disambiguate that if I want to compute the investment returns via real estate of US investors. So I also need the, you can call it the flow data. I also need the net inflow or outflow into that asset class. And Federal Reserve provides that as well. I don't have a picture of that here, but they exactly provide that as well, that in each of these segments, what is the net inflow and outflow. So based on these two data sources, you can compute exactly that, okay, last quarter, investors had 26.166 trillion, and this quarter they have this much, and if you remove the inflow, then the pure appreciation of it is this much. So from that I can compute the returns that investors achieved on each of these asset classes. This is all we need to compute on a quarterly basis the returns of US households as a group. I think from an investor index that is measured quarterly, that would be completely accurate. To fill up the gaps, these are quarterly snapshots, to fill up the gap between them, one can, what one can do is look at the asset allocation that we know at the end of the last quarter and sort of project how it would change while the quarter is unrolling. What we don't know is how much they're buying and selling. So you will have, like, if you want to be very accurate, then you'll want to make a model for that. But at least what you can do is at the end of the quarter, when you have the information, you can adjust the index. I want to make sure that we understood the two data points here. One is we're looking at the balance sheet allocations to each sector, and we're looking at the inflow outflow in each sector, both of these on a quarterly basis, to figure out what are the investment returns of households in each sector, and then aggregate them to compute the investment returns of all households, as a group. Any questions, let me know. I know this is a technical part. Okay. So let's look at the asset allocation. I think we'll all sort of agree that over time allocation to equities has gone up, and over time sort of the allocation to fixed income has gone down. You'll also see how pension entitlements has increased. The amount of money investors expect to get from their like pensions and defined benefit plans has increased. You'll also sort of see seasonality in this, that during the crisis, you find, and perhaps this graph shows it better, but during the crisis you see a lot of changes in how the equity allocation changes. So each of these graphs has a story, but I want you to look at this graph before we go into our next poll question.
So we just have a short quiz here. I'll just give everybody like another 30 seconds to take a look at the graph before I launch the quiz. So this is again just a deeper dive into the graph that we showed on the earlier slide, and it's just breaking down the assets. And it's a lot of data, so I just want to make sure everybody's keeping up. And the question here that we'll be asking is, in which of the asset classes here was the allocation the highest compared to the historical average? Stocks, real estate, and bonds.
Now, in which asset class are we currently allocated more than we were in the past?
Okay, good job, everybody. I think most people are
okay.
paying attention. Yeah, good. That's good. So if you take a look again at the graph, you can see that the right answer is stocks. Okay, Gaurav, you can go ahead with it.
Yeah, so I'll take it slow. Look, this is not, I know this is not, earth-shattering like research, but this is sort of so foundational, and yet it's not anywhere. This information is, I think everybody should know this, should have access to this, and yet it's not in the workflow of an average investor. Let's take it slow and see what's happening here. We took the Federal Reserve data that was in actual dollar amounts, billions and trillions. From that, we computed every quarter the net assets and net liabilities of investors, a net balance sheet. From that, we saw how much is invested in each of these asset classes. Deposits here just means cash in the bank. And we try to say, okay, how is this allocation changing? In this graph, I'm showing numbers just over the last 20 years, but you can make fairly long, like you have data since 1950s to observe long-term patterns. If you look at stocks on your bottom left, that's the right answer for the poll question. Stocks, currently we are allocated more than we were historically. Real estate is actually almost at the bottom end of the range. Now, and bonds certainly as well, bottom end of the range. Now, stocks, before the crash of 2000s, the tech bubble burst, the allocation was very high compared to historical standards, right? But it moved a lot, primarily because of valuation changes. Again, you see a very fast drop in the financial crisis and a V-shaped recovery after 2009, after March 2009. Till 2013, if you look at the flow data, actually people were not adding to their stocks allocation. It was appreciating, so the percentage allocation goes up just because of appreciation, but not because of inflows and outflows. I mean, there was more outflows than inflow. And since 2013, inflow has been positive. Right now, if you include the indirect allocation that we have to stocks through 401ks and IRAs, etc., the net allocation is close to 50% to stocks. Why is this relevant? Well, firstly, if you're looking at a 70-year history and we are allocated more to an asset class than we were, much more than we were over the last 70 years, there's something we are missing now. But I think also in the context of a perennial question, like a question that many of us are revisiting nowadays, are market stoppy. I think another way to ask is, are we over allocated, and if so, by how much?
So we just want to encourage people to ask questions, and a lot of this research that we have done here is obviously based on fundamental data. And the best part I personally feel about this data that it's freely available, and it's more of a function of putting in the work and cleaning the data and processing the data. So we have one question from Cable. Why do you think investment in bonds, treasury spiked after the financial crisis?
So obviously one reason the allocation increased in bonds after the financial crisis is because this is allocation compared, like we are computing percentages. So if something else falls, then naturally the allocation will go up. But the increase here is quite substantial. I think that the appreciation of risk goes up after a crisis, and instruments which sort of are positively related to riskier times like bonds, people generally allocated more to it. So it might have been related to the risk expectation. And there is a chart after this that shows the wealth decline of investors, and there I will go into this in more detail.
And I mean, when I was working at Brevin a couple of years ago, I would see so much money being spent in collecting this kind of information, which through relationships, through deep research-based, consulting firms. And it's almost funny that, while you have this information freely available through the Federal Reserve, and it's good quality information, they have put in so much effort in making it available to the general public. Very few funds, hedge funds, asset managers are able to take advantage of it. It's almost unfortunate. We have a question from Alok here. How does qplum leverage all this information to make investment allocation?
I'm going to step back from qplum and let me ask this question as how will anybody use this information? The first thing we have to do is make a proper benchmark. Since March 2009 till now, US stocks have gone up more than 400%. And none of us, statistically speaking, very few of us would have seen our net wealth purely by investment returns go up 400%. And that's right. That's and it doesn't make sense to compare to US stocks, yet most of us do. Yet most of us, so firstly we need to figure out the right benchmark, okay? Next, we need to figure out, are there predictable patterns? So for instance, we were talking, are investors over allocated to stocks? And Robert Shiller has been saying the same thing. It's not about a crash in stocks or not. We just need to ask, are we over allocated? And if so, then we can anticipate changes in allocation in future.
The way I look at it, Gaurav, is also this is truly a data-driven way of decision making. So Alok, to answer your question specifically, we do use this information in investment allocation at qplum here. And a lot of times it is to break conventional myths or, just not getting caught up in what's in Wall Street Journal and what's in the news flash. People worry about, oh, stocks are high, but then real estate is also booming in my area. But they don't, it's all based on gut instincts and not based on data. And this kind of high quality data helps us demystify what asset classes to focus on, which asset classes to make more strategies on, and also to use this data itself as a trading signal potentially, which we'll discuss later in the slides on how we use this data and can actually make a trading strategy, representative trading strategy out of it. Nick here has a question. How much should be invested in stocks? 25%?
Very good question, and I think that simple answer will be if you look at the time series, perhaps over a long period of time, and the average value of it is a baseline answer. I mean, practically we are. It's not the case that this time is different. It's not the case that suddenly equities have changed in character than they were over the last 70 years. So yes, a long-term average would be a baseline answer. A secondary answer would be perhaps we look into exactly the volatility of stocks and a long-term average and look at parts when the volatility was similar. So you can do a lot of things. But yes, that's a very pertinent question. The way to answer that is to look at long-term averages.
And the way we answer this question here at qplum, Nick, is we keep the allocation dynamic. It's a difficult question for an investor to answer every day or every month. It's even difficult for an asset manager, even for a trader, to answer this question every day, every month, and even though that's their full-time job. And that is why you have to invest in systems. That is why we chose to invest in systems that answer this question for us instead of us having to make these calls. So more generally speaking, it's called a dynamic asset allocation, which means instead of me having to determine how much should my clients be invested in stocks, the strategies determine that based on the regime that the markets are in. I'll take one more question since we have some very interesting analysis left that we want to make sure we have time for. Does it make sense to shift allocation from stocks to real estate and vice versa based on economic cycles? This is from Sumit.
So Sumit, you're right that there is a lot of data that one needs to look at in this dynamic asset allocation, and we do look at that. In this webinar, we're looking at data that so far I'm sure most of you are not using in this decision making. I'm just looking at what are currently people allocating in and what have they been doing in the past. So, yes, economic cycles, economic data, all of that is very relevant. But here I'm just saying it's obvious that our allocations to real estate is lower than the average in the past. It's obvious that stocks allocation is more than what was in the past. And any time series, if you look at long-term average, and you'll find there's a lot of mean reversion to the mean. So I think that apart from other indicators like economic data, looking at our behavioral biases helps us figure out a good way of changing dynamic allocation.
Okay, so continuing on some of the more interesting analysis now that we have established the benchmark, and we all have some data that we can now study. I do have one more question, but I'll take that towards the end if you don't mind. Gaurav, you want to continue?
Yeah. So what we are doing exactly to compute the US Investor Index is on every quarterly update to the balance sheet by the Federal Reserve, we update the current allocation, which means that for every asset class we see how much is allocated now and divide that by the total household wealth, which is I think around 96 trillion right now. And that gives us the allocation to each sector. We also compute the realized returns of the previous quarter by looking at, this is the amount that was invested in last quarter, this is the amount that Fed said is in that asset class in this quarter. So the difference minus the inflow is the investment returns. Now, during the quarter, we have been sort of projecting what the returns would be based on what we thought was the current allocation at the end of the last quarter. We will need to adjust those estimates based on the current the returns that we computed in step 2. That's it. We just do these 3 things to every time we get new information from the Federal Reserve. Okay. So we have made this into an index and just a nice upward-looking chart. But let's look at some stories here. This investor index is what would be the growth of a portfolio if it is invested alongside what an average investor is doing. That's the US Investor Index. What would be my investment returns if I'm doing exactly what an average US investor is doing with all their money? Now let's see some drops in wealth. Now there is a sub story here but let's look at the data first. Our US household wealth increases by either investment returns, positive investment returns, or from income. So even if we don't have investment returns, overall we generally have positive income, and from that also the wealth increases. Here we looked at the drops in US household wealth in the past. And each of these big drops correspond to sort of crisis at the time. If you look at the drops at the end, the biggest one is the financial crisis, which was up to 18%. But every other drop, including the tech bubble burst, was just shy of 5%. It was a huge deal at the time. And if you look at the data around 70s and 60s, there were crises. There were periods that would be described as very poor investment returns, and yet the US household wealth never dropped more than 5%. Why is this relevant? I'm trying to say that a 5% drop in actual net wealth is what we would describe as a panic situation. We hate to lose money. We hate to lose money when taking into account our income. Okay? If we look at our net wealth and our wealth drops by 5% in average, then it's a panic situation. Now think, if you couple this information with our current allocation to stocks, which is around 50%, without including income, all you need is stocks to drop 10%, and you have a situation where US investors are losing more money than any panic apart from the financial crisis. Just 10%. A 10% drop is nothing. In stocks which have a volatility of 18% in average, 10% is nothing. It also shows us what one of the questions referred to is the changing perception of risk. I think that these are questions that one needs, as certainly we try to take into account when figuring out how will investors respond to future changes in asset prices. There's I want to sort of, and there are slides I mentioned the first screen, that there's some references that sort of talk about how this data is useful. Let's look at some interesting information. If you look at the US Investor Index in blue here, and you compare it to hedge fund index, this one is by HFRX, Hedge Fund Research, that's in orange. US investors have in average done much better than hedge funds as a whole. Sure, they have high fees and stuff, but it is, if you go to a typical endowment and then the endowment model and investing in alternatives, etc., this would be hard to stomach. I think what I'm trying to say is that regardless of how we invest, practically we have actually done well, and part of that is because we are somewhat fairly diversified. One of the questions here was, what can I do with this data? And you can, I mean, this is an elementary or the first level research that we did. That if you look at the allocation data and you try to figure out a momentum approach will be to invest more in asset classes that are picking up now, and a long-term mean reversion approach will be to sort of reduce allocation to asset classes where current allocation is much higher than average, like we are talking about stocks. So both of these are fairly, they're better than the index itself, and we are combining them into this red line, and we are comparing it to even 60-40. What we are calling here is the US investor database strategy. This looks at household allocations and figures out a dynamic allocation based on, okay, what sectors are picking up, and secondly, what sectors are overbought or oversold. Not only is this better than the US Investor Index, it is even better than 60/40, which is certainly a much more aggressive index. So before we talk more about the scientific method, I'm going to take some questions. So Shankar here says, I'm a little skeptical about using this benchmark given the fact that it's driven by a lot of inertia. Is there a benchmark that indicates where new cash is being allocated dynamically? I think what Shankar is referring to is that if I have new money, let's say I got a bonus and stuff, is there a benchmark that says how should I invest that new money? Well, that might be a fair question. I think that's missing the point. I think if you look at what FINRA suggests as well, that you need to make a holistic benchmark and see what you are doing with all your money and compare that to what others are doing with all their money, so that you figure out what are you doing different, and if that is genuinely something you have an opinion on, or is it incidental?
I do think that this benchmark, in fact, is taking into account, as Gaurav mentioned, the behavioral biases. So it's actually quite pragmatic and does not have inertia, because instead of asking you to base it off price movement or volume data,
or what do you read in the news,
this is actually based on what people are doing, and I think that is more representative of actual activities. So I would think it is taking into account the new cash, and it is a dynamic benchmark in some ways. We do have some more questions coming in. So,
let's take questions.
Let's take some questions here. Does investor index include hedge funds?
So Alok, we are including raw data. We are not including intermediary data. Hedge fund is nothing but an advisor. Hedge fund is nothing but a person figuring out for some investors, how do I invest their allocation? But let's say you have investors ABC and a hedge fund is investing their money ABC in stocks, bonds, real estate. We are collapsing this and figuring out what are ABC doing. So it doesn't matter to us who the intermediaries are, like hedge funds, mutual funds, etc.
Okay. How did you calculate the previous graph? I'm trying to figure out which graph.
I'm sorry, Senuja asked a question about how to recalculate the previous graph. The only graph that
which graph?
that is of note that you'd want to remember is this U.S. Investor Index graph. The way we let's assume that that's what you were referring to. So the way we calculated this is the graph of how a portfolio would grow if you invest some money in 1995 and if it grows according to the investment returns, not due to wealth, just the investment returns of how US investors as a whole are investing right now.
Okay, we have quite a few coming in, so I just want to be sure we cover. Does it take into account outside forces, political or others?
Yeah, so this takes into account everything. Again, it's almost like we are going to every household, asking them, can you tell me all your books? And I mean, not us, Federal Reserve. And based on the raw data, we are doing the math. Mansi, would you describe it differently?
I would say it's a supply-demand measure and not an economic measure, and that's what makes it a little bit different than more traditional indicators that most traders or investors are used to. We are used to seeing, like, okay, scenario analysis or macroeconomic indicators or micro indicators. This is more a representation of supply-demand. Do you think it is better to spread out capital over many investments or just trade one particular market?
In practice, what people do is they are quite diversified. And if you choose not to do that, you need to understand how you're deviating from the benchmark. So, I mean, I personally believe in a dynamic allocation, which is based on a number of alternative risk premia. But for you, if you have a very strong opinion on something, at least you need to be cognizant of what are others doing, and the way I'm differing from others should be what you want to do. It should not be incidental.
And I mean, as we saw here in the graph as well, right? It's definitely more diversified than sometimes we assume U.S. households to be. So my first reading from this data when I saw, I was pleasantly surprised that people do change their allocation quite frequently, and that's a good thing. We almost assume that the retail investor does not change allocation very frequently, but that is not true. Is qplum working on developing strategies with focus on individual stocks versus ETFs? That would make for another very good presentation on why we choose to trade a universe of 200 ETFs versus trading individual stocks. We do have the ability to trade individual stocks as well. We have chosen to trade ETFs, and we actively monitor all the global ETFs that trade, and we've narrowed it down to a universe of 200 ETFs that we actively trade for all our clients. And out of that, one can see that, say, on average in a given portfolio or in a given account, we have about 60 to 80 ETFs on any given day that we are trading.
Robert has asked here, is it inflation adjusted? No, these are just computed returns. These are just like we looked at how much was invested in, let's take real estate for example. We looked at how much was invested in Q4. We looked at how much was invested in Q1. And then the difference, from that we removed the inflow. So we got the pure, we got the appreciation due to investment gains. At the end, it is from this series, you can remove inflation. We have not done it in this index, but it's a valid point to look at the investment returns, adjusting for inflation, the risk-free rate, and other things.
This is mostly raw. Okay, Shankha is asking, I really like your platform a lot from a background of building similar stuff for mortgages or real estate. I'm interested in knowing if you have systematic risk management. What is your approach to managing risk? Absolutely. And while we're not covering our services here in the presentation, I do want to point out that anybody investing or trading should not be the same person doing their risk management. As a trader, I learned this in my first year. Usually you have a trader and you have a risk manager, and there is a reason why you have two different individuals doing these jobs. At qplum, the way we solve this problem is we have the portfolio management service, which is a system, not a person, and then we have the risk management overlaid on top of it. And I'll be happy to send you more information on how we implement structural, systematic risk management as an overlay. But that is definitely something we prioritize a lot as a pragmatic concern that almost all clients should have. Is shorting a strategy that is included? I'm not following.
I think Phil, good question. If you want to talk more generally about how can I use this data, there will be times where you'll see that you will guess correctly that investors will probably reduce their allocation to an asset class. So for instance, let's assume that we have a 80% conviction that the allocation to stocks will reduce over the next 5 years. Now, what do I do with that? I think one way to represent that opinion would be to short that sector. Another way would be to reduce allocation from the benchmark. Now, practically it depends on how strong the opinion is. If you feel that current allocation is 50% and the average allocation should be 25, that's a huge difference, and it might be, shorting might help you express your opinion better.
And as I said, if you have any questions, you can email Gaurav directly at gcheck@qplum.co. If you want to send us inquiries about our services or our platform, you can email us at contact@qplum.co, contact@qplum.co. Any feedback you have regarding the presentation and regarding the research that we have done here, we'd really appreciate it. As I mentioned before, both Gaurav and I have been surrounded by a lot of firms, a lot of people who take a lot of time and effort, spend a lot of money collecting data, finding that little edge that can make them stand out. Trading world is competitive, of course, and what we find here is that a lot of times the solutions don't have to be that glamorous. There is a lot of value in data as long as you do a good job of cleaning it, you develop a pipeline of processing it, and then you understand what is this data being used for. So with that, I would say our session would be coming to an end.
Just one suggestion, everyone. To me, at least, this was very, very new, and I think this is such a foundational thing that all of us would want to discuss it with others, would want to debate it with others. I would suggest you guys to look at the slides again, argue it, but include this in your process, in your scientific method of investing.
Thank you, everyone. Cynthia, with that, you can take the controls back if you'd like.
Well, Nancy and Gaurav, thank you so much for today's presentation. And I am going to grab the presenter role back right now, because what I do want to do is also show folks that qplum is available on the Interactive Broker website in our investor marketplace. Let me start showing my screen. Okay, here we do have that screenshot. So you can find out more information about qplum and even get in touch with them as well. Notice if you go to the Interactive Broker website, under the Products menu, you'll find the Investor Marketplace. Simply drilling down through here, you can find services, and I'm going to go into the Find Services section and make a selection here, and then notice once you've determine who you are, you can also get into the advisors that do participate in our advisor marketplace. Now, from this page, I'm going to actually do a quick find for qplum, and notice as soon as I do, you'll see it jump down to that section lower down on the screen where you can find qplum, can drill down for additional information, and contacts as well. So with that, I want to thank qplum's principals, both Nancy and Gaurav, for today's presentation. And I see there is a request for a copy of the slides. Well, actually, you will be getting the slides along with a direct link to today's recorded playback soon or later on this afternoon. As soon as I get it compiled and uploaded to our servers, each of you will get that follow-up link with the recording and access to the webinar notes or today's slide presentation. So with that, once again, I want to thank qplum for delivering today's topic, and also I want to thank all of you for joining us here this afternoon and making today's event possible. So with that, I'm going to stop the recording right now, and you can all exit using the X at the top of your control panel. Thanks, everyone. Have a great great rest of your day. Thanks all. Have a good one.